Hello everyone, and welcome to this new class on candlestick patterns. Today, we're going to break down the most important aspects and study strategies based on these patterns. First, we'll go over some key concepts. Then we'll analyze strong candles, followed by long wick candles. After that, we'll take a look at the Harami pattern, and finally, we'll study the different Doji candle. Alright, let's start with key concepts. First, you need to know that candlestick patterns can predict the next 1 to 3 candles. Thus, these patterns are used for short-term predictions. Candlestick patterns work on all time frames, but smaller ones favor responsiveness over accuracy. This is the trade-off between responsiveness and accuracy in trading, which is well known to traders. Third, candlestick patterns don't work 100% of the time. The average win rate is around 65%. And finally, with candlestick patterns, stop loss and take profit can be easily calculated. Let me explain. So, here we have a candlestick pattern called the hanging man. In fact, there's a strong bullish trend, and then there's a candle that looks like a hanging man at the top of the trend. It's a reversal pattern. We should enter when the breakout of the candlestick pattern occurs, not before, to be sure that the reversal is happening. Then we place our stop loss at the previous swing high or low. Since this is a reversal candle, we set the stop loss at the previous swing high. After that, we set our profit target with a 2-to-1 risk-reward ratio, as shown by the green arrow. And we exit after 3 candles to prevent the pattern from failing. Of course, if there's another price action that confirms the reversal, you can wait longer than 3 candles. Okay, let's move to trading view. Here, we have our hanging man. We can open a position here, right at the breakout of this pattern. We set our stop at the previous swing high, here, and our take profit with a risk-reward ratio of 2-to-1, as we can see here. Now, let's see how the price will react. This candlestick pattern was a good one, and the price strongly reversed. Our TP is reached. Alright, let's now talk about strong candles, which are candles with a large body. First, we're going to study the bearish 3-line strike pattern. It looks like this, and you should know that this is one of the best candlestick patterns according to backtesting. Prices close higher within 3 days 81% of the time, which is a very strong statistic for a candlestick pattern. The pattern is formed with a strong candle that engulfs the previous 3 bearish candles. As we can see in this image, there is 3 bearish candles, followed by 1 strong candle. This candle can be called a Marubozu because it has very small wicks. It engulfs the previous 3 candles. However, be aware that some candlestick patterns are not always perfectly precise. In this case, the low of the last candle is not fully engulfed by the Marubozu. As all patterns, it is subjective. This pattern is a bullish signal on break of Marubozu high. So here we have our bearish 3-line strike, with 3 bearish candles and 1 Marubozu. According to the previous rules, we can open a long position at the breakout of the high of the pattern, and put a stop loss at the previous swing low, here. We set our profit to have a risk-reward ratio of 2-to-1, as we can see here. Let's see what the price will do. The 3 candles that follow showed a strong movement, and according to the rules, since there's no additional price action, we exit after the closure of the 3rd candle, here. Now, let's discuss the bullish 3-line strike. It's the exact same pattern but reversed. In fact, we can see 3 bullish candles here, and a Marubozu that engulfs these 3. Let's move to trading view. Here we have our bullish 3-line strike. We can see that after the formation of this pattern, price decreases. Alright, let's now talk about the bullish engulfing pattern. A bullish engulfing is less rare than the 3-line strike. In fact, there is a strong candle that engulfs the previous bearish candle, instead of 3, like in the 3-line strike. So here, it's only 1 candle being engulfed, as we can see in this picture. The strong body of this bullish candle gives us a clear direction to follow. So, let's move to trading view. We can see our bullish engulfing here. According to the rules, I can open a long position at the breakout of the high of this candle, set my stop at the previous swing low, and set my target with a risk ratio of 2-to-1. And as we can see, our take profit is successfully reached. About the bearish engulfing. It's the exact same concept, but reversed. In fact, as we can see in this picture, there is a strong candle that engulfs the previous bullish candle. This strong candle gives us the direction to follow, the direction to the south. As we can see, we have a bearish setup due to the engulfing candle. And if we look at what the price will do, we can clearly see that the next days are bearish. Okay, let's now see long wick candles, meaning candles with long shadows. The first pattern we're going to study is the most famous one, called the hammer. A hammer looks like this, and appears at the end of a downtrend. Its characteristics are a long bearish wick and a small body at the top, as we can see in this picture. A very important thing to note is that a hammer can be either a red or a green candle. The interpretation remains the same. This pattern signals a reversal in a downtrend. Let's analyze a hammer. Here, we have a small body with a long bearish wick, so it's a hammer. We can also see that the hammer reacts at the previous support, which I mark here, adding extra confirmation that the price is reversing. So we can open a long position at the breakout of the high of the confirmation candle. We put our stop loss at the previous swing low and set our take profit here, to have a risk-reward ratio of 2 to 1. And as we can see, our take profit is successfully reached. Let's study the hanging man pattern. The hanging man has the same shape as a hammer, but appears at the top of an uptrend instead of the bottom of a downtrend. In fact, as we can see in this picture, there is a long, bearish wick and a small body at the top. The signal is simple. If there's a breakout below the low of this candle, we have to enter short. So here we have our hanging man with its characteristics. Plus we can see that the hanging man forms at a previous resistance level. This is additional price action confirming that the price is reversing. So we can open a short position if the price breaks below the low of this candle. We put our stop loss here, and our take profit just here. And as we can see, the price drops sharply. About the inverted hammer. You have to know that it appears at the end of a downtrend. Its characteristics are a long bullish wick and a small body at the bottom of the candle. That's why it's called an inverted hammer, because it looks like a hammer but flipped upside down. Like a hammer, this candle can be red or green. And the signal is simple. If there's a breakout above the high of the candle, we have to go long. Let's move to trading view. Here we have our inverted hammer with a long bullish wick and a small body. Let's see what the price will do. It increases, meaning the trend is finished. Now, let's study the shooting star. It looks like this. It has the same shape as an inverted hammer, but appears at the top of an uptrend instead of at the bottom of a downtrend. The signal is similar to every top reversal candles. As soon as there's a breakout below the low of the candle, we have to enter short, meaning the trend is reversing. So here, we have our shooting star with a small body at the bottom of the candle and a long bullish wick. According to the rules, we can place a short position if the price breaks below this level. We put our stop loss at the previous swing high and set our take profit just here. And as we can see, the price reaches our take profit successfully after 3 candles. Alright, let's now discuss the Harami pattern, which is a narrow range candle before a reversal. The first pattern we're going to study is the bullish Harami. It looks like this. First, there's a long candle at the end of a trend. As we can see here, we have a bearish candle. The next candle is a narrow range candle, meaning that its high and low stay within the high and low of the previous candle. Then, the candle that follows is the breakout candle. It means that the high of this candle breaks out of the range, as we can see here. In this kind of pattern, we have to go long once there is a breakout above the high of the last candle. Okay, let's move over to trading view. Here, we have a bullish Harami. We can notice that this bullish Harami is forming at this key level, right here, which is the previous support. So, there is additional confirmation that the price could reverse. We can open a position at the breakout of the last high, set our stop loss at the previous swing low, and place our take profit just here. Let's see what the price will do. Our TP is reached. Now, let's see the bearish Harami. It's the exact same pattern, just in the opposite direction. In fact, we have a long candle right here, which is a bullish one, followed by a narrow candle. This second candle stays within the high and low of the previous one. Then, the next candle is the breakout candle, breaking below the low, as we can see here. The signal is the same. When the last candle is broken, we enter a short position. So here, we have a bearish Harami. We can see that this bearish Harami is forming at a previous resistance level, which has already been tested twice. This third test could also be a reversal signal. So, we open a short position at the breakout of this candle, set our stop loss here, and place our take profit here. Let's see if this Harami was a good one. Yes, the price is dropping. Okay, now we're going to study the Doji, which is a very famous candlestick. It can indicate indecision in the market. First, the classic Doji. Looks like this. It's a candle where the open and close are at the same level. As we can see, it shows traders' indecision. If it appears at the end of a trend, it's considered a reversal candle. Of course, we have to wait for a breakout of its high or low before entering a position. In this picture, the candle forms at the bottom of the trend, so we could expect a bullish move. Let's check it out on TradingView. Here, we have our Doji, and we can see that it forms after this bearish trend. And if we look closer, it also forms at this support level, where the price has bounced several times. So, we can open a long position at the breakout of its high, put the stop loss at its low, and set our take profit just here. As we can see, the price increases sharply, and our TP is reached. Let's now study a specific Doji called the Dragonfly. It's a Doji because the open and close are at the same level, but it has a very long lower wick. This candle is a bullish signal, and it's a very powerful signal when it appears at the bottom of a trend. In fact, in the picture, we can see that after this candle, which forms at the end of the trend, the price increases sharply. About the Gravestone Doji. It's also a Doji, but with a long upper wick, making it the opposite of a Dragonfly Doji. This candle is a bearish signal, and it's very powerful at the top of a trend. In fact, in this picture, we can spot two Gravestone Doji, here and here. And we can see that the price drops sharply after these candles form. Let's now discuss the bullish abandoned baby. This pattern looks like this. First, there is a bearish candle, followed by a Doji, and then a bullish candle. Important: the Doji is surrounded by gaps, as we can see in this picture. And a breakout of the last high gives a long signal, as usual. Alright, we have our abandoned baby here. We can see that this Doji forms at a previous support level, where the price bounced before. It adds reversal confirmation through price action. We can then open a long position at the breakout of the high of this candle, set our stop loss right here, and place our take profit right here. Let's see what the price will do. The price increases nicely, and our take profit is reached. About the bearish abandoned baby. You can imagine that this is the exact same pattern but in the opposite direction. In fact, we have a bullish candle, then a Doji, followed by a bearish candle, and a gap is surrounding the Doji. This pattern is a bearish signal. Let's move to TradingView. We can see our abandoned baby right here, and if we look closer, we can see that it's forming at a previous support level here. The price bounced here, and this support has now become a resistance level, which strengthens the signal. So, we can open a short position right here. We place our stop at the high of the Doji and set our take profit to have a risk-reward ratio of 2. And, as we can see, our take profit is reached after 3 consecutive candles. So, let's wrap up this class with a quick conclusion. First, you have to know that candlestick patterns are very powerful when combined with other price action elements, like support, resistance, trend lines, and so on. Secondly, strong bodies indicate traders' conviction and a movement to follow. Long wicks show that prices are pushing in one direction and therefore a strong rejection. And finally, Doji signals indecision and then a potential reversal. Thanks a lot for joining me, and see you in the next class.